Hi everybody, welcome to another update on the stock screener. Today we're going to talk about this new gem that I discovered from the stock picking contests on CEO.ca, Avricore Health. This was the only company that I thought was undervalued and not a crap stock. So look at the chart. It started to rise somewhere in 2020, then it went back down, and then this year it is getting traction again. I think this is going higher in the future. So what does this company do? It's really easy. It's just a testing company for diabetes and other drugs, and they are partnered with Abbott. So that's a big company, and they are rolling out these devices in pharmacies now in Alberta, but they will also go international in EU, USA. So rapid growth. There could be news this quarter about them getting internationally. So we're still in Alberta, Canada, Ontario, but they will rapidly expand. So what's their revenue model? So basically they have, first thing is the system fee, which is $250 per month per pharmacy. Okay, they get this fee. So it's a SaaS model, and they also get 30% on the test margin. So I think this is 30% on the revenue that they get in these stores from the tests. So for example, if you have a store that earns 2,000 per month in testing, then they get 30% of that, right? There are stores that only earn 1,000 per month because nobody uses the tests, but there are also stores that use a lot of tests and then they get 4,000 per month. So these are the numbers that they get. The CEO says that it will be on the higher end eventually. So 4,000, 5,000 per month. And then they get 30% of that. So now we can calculate the earnings. So let's take 3,000 per month per store. Test margin 30%, system fee 250 per month per store. So today they have 103 stores, actually 166. This was the last time. Today it's 166, and they already have sent out the systems for 416 stores. So they are going to 416. And in the future, it goes to 1,000 and then to 2,000. This is by the end of this year. This is by the end of next year. Okay, so you need to wait at least 2 years to see this grow. Okay, so system fee is 250 fee per month times the amount of health tab systems times 12 for a year, and that will give us earnings of 300,000 per year. So for today they have 416 stores, so that's about 1 million per year that they get fixed. That's a fixed cost, a fixed revenue of 1 million per year. Not bad. Test revenue is higher than the system fee and depends on how much these stores make. So for example, this is the amount of stores times the store earnings per month times 30% that they get times 12 months. So that gives us 4 million in revenue. So this plus this is 5 million, and gross profit margin is about 40%. So I used 40%, and net income margin is 80% of that, based on these numbers here that they project. So at 416, I get net income of around 2 million. At, let's say, 930, I get 4 million net income. So that's the same here, 3 million, 4 million, depending, of course, on how many patients per day that use it. So the numbers match, okay? And then you scale up to 2,000 store locations, and then you get around 10 million per year net income. What's the market cap today? 30 million. So that's a PE of 3, right? PE of 3 in a few years for a company that has good margins. 40% margins. So revenue is 30 million and net income is 10 million. So 30% net margin. That's a good margin. SaaS model. Depends on how many patients use this system. All right, so now let's look at the projections. So let's start with the current numbers. So the current numbers are this here. Let's take this. So these are the current numbers. Let's take also the store locations. So you can see the equity is going down. You can also see the revenue is rising. Net profit is always negative because they haven't had traction yet, but the gross profit is starting to rise. Now these are the store locations that I have added, but delayed by 1 quarter. So I have delayed it by 1 quarter because I think there is a delay on the earnings that are going to be received. So for example, this is the 103, 466, and you can see that the earnings, the revenue is following the locations. Right? If the locations go up, then the revenue starts going up. So now we use the projections. Let's see what this actually is doing. You see it? Locations going up, and the revenue should be going up as well. So it is correlated. The more locations there are, the higher the revenue goes. Okay. So now let's project what is going to happen in the future. So let's say we already know that it's 416 locations currently, but it is going to 1,000 by the end of this year. So in the following quarters, it goes up like this to 1,000. So that's here, the locations. And then it goes to 2,500. That's what the CEO said. They will go to 2,500 in 2024, and then probably keeps on rising like this. And based on these locations, I projected like this. This is the revenue projection. So I use this revenue with the delayed locations of 103 going to 166. So revenue divided by 103 times 166. And then the next one I use divided by 103 times 416, and so on. The gross profit, I took the 40% of that because that's the gross margin. And for net profit, I took this times 80%. And this is the equity, is just this plus the net earnings. This equity plus the net earnings. Okay, and then I just extrapolate it, and that gives this chart. So in 2 years from now, so if you wait 1 year, 2 years, then we will see a net profit of 3.5 million per quarter. So times 4, it's about 15 million. 15 million is a PE of 2. That's undervalued. Okay, PE of 2 with high growth coming, going international, etc. The equity, this is the equity, is also starting to rise. So we have an inflection point here in 2023. They are going from negative earnings to positive earnings. That's when you buy a company. You want to buy when these companies go into profit, and then the equity starts rising. So currently we are 30 million, somewhere here, 30 million market cap. So you wait 2 years or 1 year, and eventually the market cap will follow the equity. Equity is rising like this. So the market cap should do something like this and then start rising together with the net profits that are also rising. Revenue is also rising based on the store locations, and store locations are projected to go up because the CEO said it. Now, the risk is, of course, that these store locations do not go up, and then it stays at 1,000 or something like that. But that's the risk that you need to take. Maybe patients are not going to use it, or maybe pharmacies won't use it anymore. So that's the risk. But if the CEO's projections are correct, then we should see this grow like on this chart. So it can grow very fast. For example, here in March 2025, we will already have like 20 million net earnings. That's a P of 1.5. So this is at 2,200 store locations. When we look at the numbers here, it matches the 20 million net income. Okay. So 20 million net income in about 2 years. Could grow even faster if this becomes a hype and more patients use it, then we could grow even faster. But on the low side, I think this should be a double, maybe a triple in 2 years. So it's a good bet. It is going to be having positive earnings going forward because the store locations are going up. So this is currently what's going to happen. We are currently at 166 locations, but they already have sent out the devices for 400 locations. So yeah, just look at this. Look at this. This is the revenue, and the revenue is exactly following the delayed locations. See this? It actually matches perfectly as the delayed by 1/4 locations go up, the revenue will also follow like this. So for the next quarter, I expect this to be around this level, around 1 million revenue per quarter. And that's my projection here. That's 1 million for Q4. Okay, and then you derive the net earnings from that. So we will be here, and yeah, that's for Q4. And for Q1, then this will rise like this to 3 million. So here and then here, because we have a huge spike in locations, delayed, of course, because financials don't always appear immediately. So in Q1, we will see the revenue be around 2.5. That's this, 2.5 in revenue, okay? Which will give around 1 million net earnings. 1 million net earnings. Okay, that's for Q1, which is 4 million per year. That's not bad. That's a PE of 8. And then we go from 400 to 1,000 for this year. So that's a doubling in stores. And that will do things like this. So the projection so these are the locations. Locations going up, and then the revenue will also follow this path, right? Going to the following scenario. So I think I will keep on buying this company as long as it stays at the current market cap. We will follow up on the store locations. It needs to rise to 1,000 and 2,500. So let's assess this in a few months, a few quarters from now, and to see if they will hit these targets. And if they do, then we could see by the end of the year, so somewhere here, we could see net earnings of 6 million, maybe 7 million. So that would be a PE of 6, 5, 4. So PE of 5 by the end of the year is not bad. It's not a bad company, especially for a growth company. So give it some time. And let's see if they can get to a PE of 5 by the end of the year, with additional upside internationally, because now they are only in Canada. They can expand to Europe and to USA. So that's additional upside. All right, that was the update, and I'll see you in the next video.